Obviously, today was a little bit of a wild card, right? We weren't expecting President Trump to tweet about oil. Should it have moved the price?
Well, I think the fact is right now we have a lot of wild cards in the market, and this really just added one more to it. I think one hand, it's that the second quarter, particularly in the month of May, has a lot of geopolitical supply risks on the horizon, whether it's Iran sanctions risk, whether it's ongoing drop in supply out of Venezuela, a lot of other geopolitical issues across the Middle East, North Africa, West Africa, Latin America. So adding this to it really just seems like we're waiting for more and more wild cards to pile in. And so what we have is actually a market's very positioned for this upside risk. If you look at money manager net length in Brent and WTI, by most measures, it's essentially hovering at all-time highs. So it's waiting for supply risks that may come. If they come, markets may already be positioned for it. And when you have something like today that is more of a bearish catalyst, you can see sharpish moves down at times.
So it's very hard then to talk about a longer-term forecast, but of course Citi is well known for its, quite long-term forecasts, and you've updated them in the last 6 or 12 months. Where does oil go in the intermediate and longer term, 5 years, I would say?
Sure. I actually think the long term is very important to the short term, particularly in this case, because to some extent, the Saudis, the OPEC Plus group, as they're changing their goalposts away from this near-term inventories, they're talking much more about trying to keep prices high and investment high to prevent a supply gap forming. They're worried, at least they're saying they're worried, that by 2020, this big investment drop since the oil price crash is going to leave a big deficit in the market. They're, in essence, maybe some sort of $140 type price spike risk. We at Citi are actually very much against that view. We think the 2020 timeframe looks very crowded, and in fact, that's partially due to what they're doing now. So the point is, having drawn down inventories much more quickly than would otherwise have happened, and keeping prices high, they're creating this pressure that we think in 2019 creates a lot more supply growth than maybe anticipated, and essentially inventories coming off what are currently, I would say, actually low levels, not just balanced.
Are you surprised, Eric, by the compliance levels, by the fact that there were so many doubts at the start of this process, OPEC and its allies, and OPEC has managed to hold it together, bring the surplus down, we're almost in balance, and it seems as if they want to continue and develop that relationship going forward. What can go on what can go wrong, Eric, when it comes to compliance and holding things together relationship-wise?
Yeah, I mean, I think in terms of surprises, I think the level of coherence in the group has certainly been something that looks like it's going to keep going ahead. And I think when they talk about cooperation going on, it may not be necessarily cuts going on, but certainly this framework of having particularly Russia as part of this group throughout as something continuing. The thing is, are we looking at a mini repeat of 2014 where OPEC, in this case now OPEC Plus, want to hold on to production cuts, high prices, but those ultimately being something that the market is creating pressures to thwart? And what that means is, let's say sometime later this year or next year, or it depends when OPEC Plus see that their market share is dwindling, because non-OPEC producers like the US are taking the lion's share of all the demand growth that's happening in the world. Do they look back in their history and say, we remember the 1980s, we remember when we lost a lot of market share, do we want to do that again? There's a trade-off between prices and market share.
It's fascinating because we had Russia talking today about saving Texas when it comes to the oil industry. What's the one big risk, geopolitical or otherwise, for the month of May that you see, and where could it push prices to? I mean, obviously, Iran is a risk. Further sanctions on Russia, another risk. But what's the big one you're watching?
I think it's the combination of all the above. Each of them are not given by any means. So I would say they all have low-ish probabilities individually, but any one or two of them coming on is significant. And that would push us into our bull price view, which would be towards the high 70s. We could see 80 at some point. But again, we think that that would create even more pressure in 2019. So our base case is that we stay in the sort of 60s throughout the year, and that we could be seeing the 50s or potentially even below for, let's say, WTI next year. But with a bull case, with a supply disruption, you get a sharp spike this year, but still the US supply and other non-OPEC supply reaction next year, that means that the Saudis, we think, can't see $80 oil sustained for a longer time.